Hello, I'm Brooks Hutchinson, a Vice President here at First Financial Trust and also a CPA. I'm sitting here today with.
I'm Grant Seaborn, and I'm a certified financial planner and also a vice president with First Financial Trust.
Today's topics we'll be bringing you for year-end tax planning, things that you need to consider or opportunities that may present themselves. And so our first one we want to talk to you about today is required minimum distributions from any pre-tax or qualified accounts. So Grant, will you tell us a little bit about what to consider when taking RMDs, what causes them? Give the people at home a little bit of things to consider.
Sure. Yeah. So under current law, during the year in which you attain the age of 73, you're required to take a minimum amount out of your IRA or your 401k. Your financial advisor can help you with that calculation. The IRS provides factors which you divide your year-end balance by the factors provided by the IRS to calculate that required minimum distribution. But the most important thing is that you take it in the year in which you attain the age of 73. The first year, there is a rule that allows you to delay it until the following year. You have to take it before the tax deadline of the following year. And I would consult with a professional before you make that decision of taking it within the year you attain the age of 73 or before the tax deadline of the following year. It is also important to note that if you were born in 1960 or later, that required minimum distribution age or required beginning date gets pushed out to age 75.
Yeah, they're always constantly changing those rules for us every single year. So it always seems to be getting later and later. And I think the biggest reason that it keeps getting later and later is people are working longer. So the IRS is trying to take that consideration into play. But at the same time, you got a tax deduction whenever you made that contribution, and you can't just leave that amount in that account for an infinite amount of time. The IRS wants their money back eventually, and that's why they've created these required minimum distributions, which there's a lot of planning that can go around that. So even though you're able to take money out after 59 and a half penalty free, you're still going to pay ordinary income taxes. So what are some ways whenever somebody attains the RMD age, because it is taxed at ordinary income tax rates, which are typically our highest tax brackets, what are some opportunities that people, specifically charitably, could do to help offset that tax liability that they're going into?
Sure. We had that conversation quite a bit. If you are charitably minded and you do not need the money from your IRA or 401k that would have otherwise been distributed to you through a required minimum distribution, then you could opt to take some or all of that and make a direct contribution directly from that IRA or 401k to charity. It's called a qualified charitable distribution. And when you make that direct donation to charity, whatever amount that you decide to contribute is excluded from your taxes, which oftentimes can be more advantageous than making a cash donation and taking a deduction for that gift. Now, it is limited. There is a dollar amount limitation on that. It's $108,000 in a given year under current law. But there's also an age. You have to be at least 70 and a half, which is interesting because you're not required to take your distributions until age 73, but you are allowed to make qualified charitable distributions prior to that age, as long as you have attained the age of 70 and a half.
Yeah, so just for the people at home to know the specific route that has to go, we're taking money directly out of the IRA and sending it to the qualified 501c3. It has to be a 501c3. Whereas opposed to most people, in the past would take their required minimum distribution, that amount would go down to their checking account or their savings account. They would then turn around and send that money to the 501c3. We're talking about taking that step out of the middle and sending it directly from the IRA. That way it's a dollar for dollar reduction of that taxable income when you're hitting RMD age rather than being on your Schedule A, which is subject to limitations. So even though you're being charitable in nature from your checking account, that doesn't necessarily mean that you're getting the benefit from it, whereas with a QCD, you're guaranteed the benefit after 70 and a half or any charitable donations going forward.
Absolutely. If you have further questions, call First Financial Trust to learn more.